Hi there, and welcome back. I'm Joe Travato, the mortgage guy, president and CEO of Atlanta Mortgage Advisors. Thanks for being here. Today, we're going to go a little bit deeper. The goal of this video is to help home buyers, home sellers, and real estate agents by broadening the information and broadening their perspective as to what's going on with the Fed, why are interest rates going so high, and what we can expect coming down the pipe. But first of all, let's take a quick review of the Fed. The Federal Reserve, their job is to make fiscal policy, this gentleman right here, Chairman Powell, they make fiscal policy that regulates the economy. And they do this by doing two things. Number one, they either add money to the system or they take money out of the system. And the way that they regulate it is by raising and dropping interest rates. So when the economy's in the tank and we need to grow and we need to stimulate growth, what the Fed will do is they'll lower interest rates to add that cash into the economy. And then when there's inflation, to stem off hyperinflation, which is a terrible thing, hyperinflation leads to greatly devaluation of the currency, which leads to fiscal disaster. So they want to make sure that inflation doesn't get out of control. What they do is they suck the money back out of the economy, and the matrix they use for that is they just increase interest rates. So that's when you'll see things that come up like that look like Fed hike in the news, you hear the Fed raise rates and all that good stuff. So what's going on with interest rates and when will they stop going up? So if you look at this chart right here, you'll see that inflation is currently, I think in August, it came in at 8.2%, which is slightly lower than July. So that's a good thing. So it seems like it's getting under wraps a little bit, but you won't see the interest rates come down until inflation stops going up. So the Fed said that they were basically dedicated to stopping inflation. So interest rates going up, that's something that's going to be around for just a little bit longer, right? And how does that affect us, right? Inflation is a lot of times has been called the invisible tax, or the tax that nobody sees, because when inflation means that prices go up, means your money can buy less. Therefore, when prices go up faster than wages go up, basically the wage earner takes a pay cut, which is never a good thing. So what about interest rates? How do we help our home buyers and our home sellers understand what to do or where we are? So first of all, we got to look at the interest rates. Over the last 51 years, this is the chart, the average has been 7.76% interest rates. So if you go back, you'll see during, somewhat in the 90s and in the O's, rates were well above this yellow line, which is 5%. Right. And then we had the Great Recession back in 07, 08, 09. And you see that's when rates fell below 5% and stayed there for all these years. And then we had the pandemic and boom, it dropped again. So what's happening is the hike in interest rates is to basically offset, almost 15 years of lower interest rates. The shocker is that a year ago it was 3.5% and now it's 6.8%. Or even pushing 7%. But the point of this showing you guys this is that we're not out of the woods yet. The Fed, again, has said that they're dedicated to stomping out inflation, which means, at least one or two more hikes coming down the pike. And again, rates, we don't know where it's going to stop, and rates won't come down until inflation stops. So 6.8 may look bad today, but it might look great, 2 months, 3 months, 6 months from now, if rates are 7, 8, 9%. So it's important to understand where we are. Now, what does that mean to the home buyer? Where are we with payment? What does it mean to your pocketbook? So if you're a home buyer that needs to get a mortgage, a $250,000 mortgage to buy your house at 6.8, well, you can see what the payment is, right? Here it's $1,642 for your principal and interest. Don't forget the escrows. It's about $295 a month for taxes and insurance, putting your payment just shy of $2,000. So a home buyer looking to get a loan for $250,000 is going to be about $2,000 a month. And then you can see in this market how it goes up. $400,000 loan is about $3,100 principal, interest, taxes, and insurance all in. $500,000 loan is $3,900 all in. $750,000 is just shy of $6,000. And $1 million is about $7,800 a month in payment, all in principal, interest, taxes, and insurance. So it's important to know that we cannot control interest rates and we cannot control what the Fed is going to do. But what we can control is what we're telling our clients, what we're telling our home buyers, what we're telling our home sellers, what is reality and what they can expect. And this is the cost of what it would be to be a homeowner in today's market. So, you know, the best thing you can do if you are a homeowner or you're looking to be a homeowner in this market is to understand what price point you're at and find a loan point that's affordable to you. And the other thing too about inventory, a lot of people say they want to wait until inventory goes down, right? Or inventory increases. But here's what's going on with inventory. In the Atlanta market, at least, we're still only at 2 months inventory. So we won't see a devaluation in real estate until we get to 6 or 7 months worth of inventory. So we're nowhere even close to that at this point. So waiting around for interest rates to come down or waiting around for housing prices to drop just is, you're going to be waiting a long time, I'm afraid. So I think now is an opportunity to buy real estate, but to understand what the affordability is, where the rates are and where they're going. Please call me anytime. I'm Joe Trovato, the mortgage guy. Thanks for being here and God bless.